me now on the desk for more on market trends and what we can expect in the second half of this year, which of course officially kicks off tomorrow. Deryck Janse van Rensburg, Portfolio Manager at BoE Stockbrokers. Thank you so much, Deryck, for joining us today. A momentous day, I would say, because we've got the end of quantitative easing too, and of course we've got the end of the first half of 2011.
Yeah, and it's difficult to say where we're going to go from here. And if you just look at it from the beginning of January to this point in time, the market has been plateauing and just sort of digesting a lot of the numbers that we've been seeing released fundamentally, and it really hasn't given you much upside. So, equity markets domestically haven't been very exciting for the last 6 months. And the question is, from here, where do we go? And obviously, we've got the potential of maybe some more quantitative easing coming to the picture, but that doesn't seem too likely at this point in time. However, what one must remember is that interest rates globally are going to remain low, and I still think that appetite for equities is going to remain. So although you are seeing that low base effect completely chucked out the window now, hopefully you are going to see some good solid growth coming through in company earnings, and that, in my opinion, is what's going to see our market push beyond that 33,000.
It's fascinating. I mean, you said equities are still going to be in vogue going forward, but chatting to Stephen Charles from RMB a little earlier, he said that it seems foreigners are not buying equities at this point. They're still buying into the bond market. They're buying into the yield story. Does that then mean that they're not really buying into the growth story, or do you think that this means they think equity markets are looking slightly expensive?
Well, you can see it in the rand, and I do agree with that statement. I think it's purely a yield play at this point in time. So from a conservative point of view, I think a lot of foreign investors have got appetite for our domestic bonds, and purely because the yields are attractive. If you go into a more risky asset class and you look at our local equities, there's still a lot of value to be had there. And if you just look at some of the yields that these companies are producing at this point in time and forward yields, a lot of these yields are in excess of 5%. So yes, maybe you do miss out in terms of the coupon you would get on a bond, but you do make it up in the capital gain and the growth potentially in the company in some capital gain. So I think it's purely just a short-term yield play domestically, but looking forward beyond this year and maybe a year out from here, I do see some capital gain in our equity markets, and I do think that earnings are going to give us some growth going forward.
Well, what kind of returns are you expecting for the JSE by the end of the year? Because we haven't done very much, and it's already the second half of the year, essentially.
I think it's still going to be a very choppy environment, and I think that you're going to see big swings of emotion, and when it does sort of hit the upper end of its range towards 33,500, a lot of investors are going to flurry into the market and try to buy equities, and the same applies when it does come down to that 30,000 mark. People are going to think that double dip recession is on the cards. My sense is that you are going to see us move through that 33,500 and possibly give a push towards 35,500, 36,000, about a 10% gain from our previous top. So I don't see us shooting the lights out, and I do foresee a choppy environment going forward. So you might see a spike through that, make a new high, and sort of come back towards that 33,000 mark. But in all honesty, I think it's a very healthy digestive period that we're going through.
We had PPI numbers out coming in at 6.9% year on year. Most were expecting for May, of course, and most were expecting a number above 7. Keeping that in mind, we've also had the retailers doing quite well recently. We know that CPI could disappoint down the line, so in other words, it could actually come in slightly weaker than most had expected. That means interest rates lower for longer. Any specific reason that Truworths ended the day higher today, up 2%, and in fact has actually had a couple of sessions of positivity?
Look, if you just look at the retail space over the last week, it actually sold off quite significantly when you did see our all-share index come down to just about 30,000. So they were looking quite attractive, and again, a lot of those yields were looking attractive, over 4%, some are over 4.5%. My sense is that I think that what's driving our inflation at this point in time is really the cost increases in electricity, the cost increases in food, and it's not really driven by pure growth that you're seeing in our country at this point in time. So the consumer is still definitely feeling the pinch, and hence you're probably going to find that these interest rates are going to be a little bit lower for longer than what a lot of analysts expect, and you possibly might even see interest rate hikes come to the fore as we kick off next year, possibly even the second quarter next year.
So you think no interest rate hike by the end of this year?
Well, that's what the market is telling me, and that's what the equity market is telling me. So if you look at these retailers, they are obviously starting to price in a lower interest rate environment for longer than what analysts are expecting, and you're possibly seeing a bit of a run-up in those retailers on the back of that.
With regards to the second top gainer on the top 40, I mean, Naspers up 1.72%. We know it's also been quite volatile. Investors really disappointed with the numbers that were released a little earlier this week. What is your sense of Naspers? Is it a good time to buy? When we do you buy in the dips, essentially?
Yes, I do buy in the dips, but what one must remember with something like Naspers is essentially what they released was actually a good set of numbers, and they're growing and they're doing some really good things. The thing is with this share is that it's almost looked a little bit too far forward, and a lot of investors have been overly optimistic on it. So the downward trend that you saw in the short term down towards 360, I definitely think has offered an opportunity. So it's kind of moving between that 360 and sort of 405, 408 level. So again, I think that it'll continue to make higher lows in the short term and essentially move beyond that 405 level and start to move out. So yes, I do think it's a buying opportunity down under 370.